Hey everybody, it's Patrick Moore with Ironclad Wealth Management here, and today's video is going to go over what the differences are when you do short-term tax planning versus what I call lifetime tax planning. And I think that everybody would say, if you were to tell them, hey, it makes more sense to plan to minimize your taxes over the rest of your life rather than just for this year, they'd be like, yeah, hey, that makes sense. It's intuitive, right? But it's hard to do, and I think it's helpful to actually quantify what those numbers look like if you don't do that tax planning the right way. So that's what we're going to talk about today. So looking at this, the first thing I want to say is that, hey, this is not individualized tax advice, right? This is general tax info, but I hope it's helpful. And when you start your small business, you probably have one of two things, even though you don't know it. You either got a good tax plan or you got a bad tax plan. There's some room in between, but if you're in that in between, what's going to happen is towards the end of the year, if you don't have a plan, you're probably going to start scrambling and look for those short term decisions to save some money, which quickly turns into a bad tax plan. So, what does a bad tax plan look like? Well, it's reactive. It prioritizes short term savings over long term savings. And typically, what happens is you wind up buying something just because it's a write off before the end of the year. And you're like, hey, yeah, I can justify doing that because I'm going to save money on taxes, which is fine, but it's not what good tax planning looks like. Good tax planning has three key characteristics: it's proactive, it's legal, and the lifetime tax savings matter more than the short term tax savings. So that's something I harp on all the time. Hopefully, you're not bored of hearing it yet, but we're going to focus on number three today. Because at the end of the day, you have to think about what your goal is. A lot of times people say, hey, my goal is I want to save money on taxes. Well, is your goal you want to save money on taxes, or is it you want to increase your net worth and have more money in your pocket? And taxes are the mechanism to accomplishing that. So I really hope that at the end of the day, for you, that good tax planning means you're putting more money in your pocket to increase your net worth. It's just the way you're doing it is by lowering your taxes. So if you lower your taxes, but it doesn't increase your net worth, is that really a good decision? We'll show you in a moment. I'm not sure it is, and the math bears that out. So good versus bad tax planning, the example I'm going to use is what I call buying depreciating assets to save money on taxes, and it'll all make sense here in just a moment. So let's say this is you. Let's say it's coming to be November. It's the end of the year, whatever. Maybe it's more like August. Who cares? But what's happening is you're having a great year. You're coming to the end of the year, and you're going to owe a lot in taxes. You're in the highest tax bracket, 37%. I'm not going to worry about state brackets on this video today. And you got $60,000 sitting in the bank that you don't need for your business, you don't need for anything personal, and you're like, hey, what can I do to lower my taxes? Well, the first option we're going to talk about is what I call the bad tax plan. Very, very sophisticated, right? But let's say you haven't planned ahead. You're hunting for that deduction. You're like, hey, what can I do? You call your accountant. Hey, what can I do? What can I buy to lower my taxes? A lot of times this winds up with you buying what I call a depreciating asset just because it saves you money on taxes. And the problem is that it's a depreciating asset you don't need. A lot of times if you call your accountant, they're going to tell you, hey, the biggest thing you can probably do is, hey, you can buy a truck through the business that's for work, and that'll get you, as long as you meet a few rules, that'll get you a full deduction of that truck's value. So you spend $60,000, get a deduction for $60,000, and now you have a vehicle. However, the problem is the vehicle is going to go down in value 20% per year. And for the purposes of comparison to a few other things I'm going to talk about today, we're going to say you sell that truck in year 6, and you then reinvest that money in an investment account that returns 7%. So what does that look like? Well, what you can see here over on the left is you can see that actually in year 1, that $60,000 turns into $70,200. And that's because you're getting that truck, which does go down in value in year 1, but you're also getting those tax savings that boost you over that $60,000, money, or, the starting point, which sounds really good until you look through years 2 through 5 when you have that truck just cratering in value, because that's what cars do. And then we sell it, and you can see that you start to kind of go up in value now that you have that investment account that's growing. At the end of 20 years, you got about $86,000. So you started with 60 and you wound up with 86,000. However, that original 60,000 that turned into the truck is only worth about 42. The rest of that difference comes from investing those tax savings. So all I'm trying to say here is that you have to do this thing properly to get this, you have to reinvest your tax savings, reinvest the truck values, and you'll see in a moment that really maybe that's not the best tax plan. So looking at this, that is what I would call the bad tax plan example, right? This is what happens when you prioritize taxes above everything else. And so let's see what happens when we look at a plan that really has your priorities in order. So what we're going to talk about next is we're going to talk about the better tax plan. You still haven't planned ahead. You're still kind of scrambling there at the end of the year. You're trying to save money on taxes, but you do understand that, hey, the reason you want to save money on taxes is purely to put more money in your pocket. That's really what it happens. So what we're going to talk about is what the opposite of option one. Option two being, hey, you're not going to get a deduction, but what happens if you buy an appreciating asset with that money? There might come a point where it just makes sense to pay those taxes. The question is, how do you show that mathematically? Well, if you remember in year one with the truck, you had $70,000. If you just pay those taxes at the end of year one, you've only got about $39,800 if you invest in a brokerage account, earning 7% after paying those taxes, which is about a $30,000 difference. And that doesn't sound great. However, if you remember in the bad tax plan, for the first 5 years, your values start to go down. And you can see that in year five, you've got $49,000, and importantly, most importantly, at the end of 20 years, you've got $106,000 versus the $86,000 from the bad or short-term tax plan. So even though you haven't done a great job of tax planning in this example, what you've done is you've still wound up with more money in your pocket long-term because you understood, hey, maybe I shouldn't chase after that deduction just for a deduction's sake, right? Does it make sense to buy that depreciating asset rather than invest in an appreciating asset? So now that we've talked about the example one where you get a deduction but a depreciating asset, and then the second one where you don't get a deduction and you get an appreciating asset, what happens if you put those two together? If you marry those two and you get a deduction and you get an appreciating asset, kind of the best of both worlds. And that's what we're going to call, for the purposes of this video today, the good tax plan. So let's say you've estimated your income, your taxes for the year, you're kind of planning ahead, and you're thinking about which option is best for you long term. So it's still about getting the most money in your pocket, not necessarily just about minimizing taxes. Well, you can get deductions and appreciating assets at the same time. There's several methods out there to do it. I think the one that I'm going to use today is just the 401k because it's the easiest to compare. So what you're going to see here is taking that same $60,000, putting it in a 401k, and taking your tax savings, because you get that same $22,200 in tax savings, and putting that in a brokerage account. So if you look at that and you kind of compare those over time, at the end of 20 years, and this is the biggest one that we've seen so far, it's about $290,000 versus 86 and 106. So there's a significant difference in what you're looking at the end of that 20-year time period. Now, there are taxes due on the 401k in the future. We'll talk about that in just a moment. But that's the power of getting both that deduction and the appreciating asset. But if you don't have it, it still makes sense to buy those appreciating assets, because as you can see on this comparison slide here, this is what that looks like. And you can see plan one on the bottom there, what I call the bad plan, right? At the end of year five, it's worse than all of the others. And the question is, are you thinking about your lifetime, or are you thinking about just this year? And I would say that you're going to have better results and a better financial future if you focus on your lifetime taxes. So you can see then that in year five, just paying the taxes, biting the bullet, and investing that money gets you, to a better place in 20 years. And then finally, if you can find a route to get a tax deduction and appreciating assets at the same time, in this scenario, we use a 401k, that the good tax plan is significantly better than the others. Now, if we look at that, let me move my little video here. You can see that the difference between plan one and plan two is $20,277. If we look at it, the difference between plan one and plan three is more than $200,000. And if we take the taxes into account on plan three is still worth about $205,000 after 37% in taxes is taken out of the 401k if you take it all at once, because some of that is made up of the tax savings from the So if you had to take away one thing from all of this, all I would say to you is, hey, really think about what matters more to you. Is it your tax savings or is it actually achieving your end goals? Because as you can see here, there's probably some situations where you can achieve your end goals faster by paying taxes. Now, if you can, accomplish both situations, then go for it, right? Find those scenarios, make the most of them. That's what good tax planning is. But think about what you have done if you haven't been thinking about your tax planning, because if you take option one versus option two, you may say, "Hey, Patrick, it's only 20,000 bucks, and I know you're not going to buy a new car every year, but what if you were to take that same mentality every year for 20 years? All of a sudden, is it a much more significant difference in your financial future?" And so I would just counsel you, hey, think about your tax plan, focus on the long term, and think about what matters to you, which hopefully it's putting more money in your pocket rather than just saving on taxes for taxes' sake. So if you sat through this video, I haven't bored you. My offer to you is, hey, if you want to do a free strategy session, you can click on the link in the chat below or in the video description. We do free, no cost, no obligation videos where we just sit down for 20 minutes, chat about what's going on in your life, and figure out if it does make sense for us to go to a further hour-long phone call where we really dig in. Now, at the very least, please think about your tax decisions in the context of your entire financial life rather than just chasing that high of saving on those taxes that one year. It's going to pay dividends in the future if you think about your taxes in the context of your entire life rather than, hey, the accountant says I'm going to owe this. What can I do to get it down? So I hope you enjoyed the video. Hope you have a great rest of the day. Send us a like. Feel free to hop over to our website, and hope you have a good one.